Hey, what's going on, guys? My name is Daniel, and in this video we're going to be looking at some of the top stocks in the market right now. If you like this video, make sure to drop a like and subscribe down below. YouTube tells me that 80% of you aren't subscribed, so if you're watching my videos and enjoying them, just make sure to drop a like and subscribe. It really helps out a lot. And let's get right into the video. So the first stock on my list is Adidas, ticker symbol ADDY. Adidas has been taking a huge hit due to the current state of the world right now. At one point in time, it has gone down 48% from its highs, which is absolutely insane if you think about it. It went down 48% from its highs. It lost almost half of its valuation due to one simple disease, which is absolutely insane if you think about it. And the main reason it fell is due to their really bad earnings during quarter one. Their first quarter profits fell by more than 90% due to this current state of the world right now. And this does not worry me at all, because this is only a short-term thing that's going to affect their business. This is not going to impact their business over the long term. Eventually, the economy has to reopen up. People are going to start going back outside again. It's just inevitable. It's going to happen. And once that happens, you're going to see a huge increase in the stock price, because it's going to be so undervalued relative to the amount of money it's going to be making in the future. Its stock price is going to be a lot higher because it has been taking such a big beating. And what's really good about this stock is their expected earnings per share. So last year during 2019, they had $5 in earnings per share. And this year, even though the economy is not great, even though a lot of people are not going outside of their house, they're still expected to make $7.70 on average in earnings per share this year, which is phenomenal growth. They're still expected to grow and persist even though this economy is not great. The main reason they're expected to still grow is because analysts are expecting them to do a lot better during quarter 3 and quarter 4. And they're expecting that quarter 2 is probably going to be the worst quarter for them. So after this month, after June pretty much, it's going to be a lot better for them. It's going to be a lot more upside from here. So there isn't a lot more downside with this stock coming in terms of impact from the current state of the world right now. And what's even better is what they're expected to make in 2021. In 2021, they're expected to have $10 in earnings per share. $10 is a lot of money in earnings per share. 10 is a lot for the stock. Take a look at their share price. It's $119 per share. And if they make $10 in earnings per share, their forward PE ratio is 11.9. 11.9 is so low just for a stock on the stock market in general. But it's also so low for Adidas, which is going to grow a lot and has a lot of potential to grow. And when you compare it to something like Nike, right? Nike is a very similar company to Adidas. It's just a different brand, but fundamentally they're really the same company. They provide very similar products and services. Nike is trading at about $93 per share, and their earnings per share during 2021 is expected to be about $2.74. That gives them a forward PE ratio of 33. 33 versus 11 is just such a huge difference. And this stock seems like a Warren Buffett style play. Back during the 2008 financial crisis, Warren Buffett invested in banks like Goldman Sachs and Bank of America because they were taking a tremendous beating. He knew that over the long term they were going to be okay, so he decided to buy them when they were taking the worst hits, when their business models looked like they were going to collapse. He decided to invest in them because he knew they were going to be okay for the long term. And it's a very similar situation with Adidas. Adidas is absolutely getting obliterated in the short term. Their quarter 1 results were absolutely terrible, but over the long term they're going to be okay. And since they've taken such a big beating in their stock price, it really creates a value opportunity to invest in the stock. And I don't think there's going to be a better opportunity to invest in this stock. So if you want to get in this stock, you really do have to get in it soon. So overall, Adidas does look like a good stock to me. And the next stock on our list is Alibaba. Alibaba is essentially, if you don't know, the foreign version of Amazon. They're a cloud computing company and they're an e-commerce business. And Alibaba has been seeing huge growth during this time. As people can't go outside their homes to shop in retail locations, they've been purchasing stuff online, kind of like how many people here in America have been purchasing stuff off of Amazon more. So they've been seeing huge growth just due to the state of the economy. I mean, you can see their revenue rose 19% during Q1 just from their e-commerce business, which is absolutely amazing. This is going to help create a lot of long-term potential customers for Alibaba. If you think about it, a lot of people still don't use e-commerce and shop online. A lot of people used to just only do brick and mortar shopping. But now, since people kind of have to try out at least e-commerce and shopping online, Alibaba is now going to have a lot of first time and new customers in their system. This is going to allow them to promote new products and discounts to new customers through email marketing and other sort of methods. So they're going to have a lot of new first-time customers, which can potentially turn into long-term customers for Alibaba. So this is actually a really good long-term growth opportunity for Alibaba. And one of their new products definitely does have a lot of potential to grow in the future. And recently, Alibaba made a $1 billion investment in their smart speaker. It's essentially the Alexa of Alibaba. It's the Amazon Alexa of Alibaba. And it's a smart speaker, and I'll be honest, right now it's not very good. It can only do very simple things, and it's only sold in China right now. But this $1 billion investment is going to take that speaker to the next level so that it can become a very competitive product in the Chinese market space. Their $1 billion investment is going to make the product more similar to the Amazon Alexa. So that's a lot higher quality product that can do a lot of more things like the Amazon Alexa, because right now the product only does really simple things like tell you what the weather is and stuff like that. It can't retrieve a lot of prices or anything like that. So right now it's a really basic product, but this $1 billion investment can really take the product to the next level. And once it does, there's going to be a ton of demand for it. Like already right now, during quarter 3 of 2019, you saw a 77.6% growth in sales from this product alone on a year-over-year basis, which is absolutely phenomenal. It shows that there's a ton of demand for this product in China. And they had 13% of the global market share in this niche, which is very, very strong for this product, which is honestly not that competitive in the market space at all. So it just shows that there's a lot of demand for this product, and it has definitely a lot of long-term potential, especially with their $1 billion investment, which can help increase their sales exponentially. And their forward PE is looking really good. Right now their forward PE ratio is 24.27, which is absolutely insane. Typically a forward PE ratio of 24 is pretty high. It's a pretty rich valuation. But this stock has a lot of growth opportunities ahead of it. So I think it's definitely justified. And right now it has a price to earnings to growth ratio of 1.25. And typically if you see it at about 1 and close to 1, it indicates that it's really undervalued. So this stock definitely has a lot of long-term growth potential because the stock is so undervalued right now. And they also have a really high profit margin at 35%. 35% is a really high profit margin for most businesses. This means that whenever there's some sort of situation that negatively impacts them, they're still going to be okay. They're keeping a lot of their revenue as profit. This means that they're going to be a-okay if something does affect their business. Say they make a bad investment, they're still going to be really good in making a lot of money because they're keeping so much of their revenue as profit. So overall, this looks like a really strong business. And the next stock on our list is PetIQ. So this stock is really interesting. PetIQ is a very small business in the grand scheme of things. It only has an $800 million market capitalization, which is tiny for stocks on the market. It's under $1 billion, which I find really interesting. And PetIQ, you probably haven't heard of it. It's essentially a company that provides services for pets. PetIQ is essentially a pet needs business. It provides stuff like pet prescription medication, over-the-counter treatments, pet supplies, pet treats, pet food, pet shampoo, and vet supplies. So this company is really diversified if you think about it because they're in a lot of niches within the pet industry. So this company is not reliant at all in one business. They have many miniature businesses, which is really good. And they also own so many brands, so they are really diversified within the pet market. And what's phenomenal about this stock is their growth and their valuation. So during 2016, they had $200 million in revenue, which is pretty solid. Then you see phenomenal growth. They made an additional $66 million in revenue by 2017. Then you see that go up to 528 million. It essentially doubled between 2017 and 2018. So you're seeing phenomenal revenue growth there. Then from 2018 to 2019, they grew their revenues phenomenally again to $700 million. So you're seeing phenomenal revenue growth with this stock. And keep in mind that this stock's valuation is at $800 million roughly. And last year they made $700 million. So you're seeing a price to revenue ratio that's very low, which indicates that this stock is very undervalued. And their balance sheet is also looking really good. They have assets of $600 million while they only have liabilities of $300 million. So they have a lot more assets than their liabilities, so they're looking really good. And on a short-term basis, they have $185 million of current assets and $73 million in current liabilities. So they have a lot more current assets and current liabilities, which is looking phenomenal for the stock. Even if their business slows down in the short term, they're going to be okay with their assets and liabilities. So they're going to be A-okay in the short term, which is phenomenal for the stock. And they also don't have a lot of long-term liabilities, non-current liabilities, which just makes the stock a really attractive investment from a balance sheet perspective. They have such a strong balance sheet than a lot of large cap companies also, which makes this stock really interesting and a really attractive investment. And right now, their stock price is trading at $28.82. And by 2021, they're expected to have $2 in earnings per share. That gives them a forward PE ratio of 14. 14 is an absolutely low PE ratio for a company that's going to grow this much, that has been growing their revenues substantially, like they've been exponentially growing, and a forward PE ratio of 14 is just really low for this stock. So overall, this stock really does seem undervalued in the market and seems like a really attractive investment. But let me know what are your thoughts down in the comments below. But overall, I hope you like this video. Make sure to drop a like and subscribe down below. And let me know what are your thoughts in the comments below on these stocks. Are you a fan of PetIQ or no? Let me know down in the comments below.